have the this is again very important topic called as transfer pricing. So the last class we've learned about responsibility centers and responsibility accounting. The organization based on its size and complexity of activities, it is divided into many subunits or divisions or departments. So each division or a department where there is a manager appointed who can take the decisions and also held responsible for the decisions which he takes, we call such a unit as a responsibility center. So there are three types of responsibility centers we've looked into. The performance evaluation is based on key variables which are used are ROI and RI, return on investment and residual income. These are the two variables. So now in such an environment, we see that every responsibility center works with an works with an intention of being appraised as the best. The attitude would be as to be evaluated as the best. So there's a kind of a competitive environment there in the organization. So everybody is focused on achieving the objectives of their particular department or their particular responsibility center. But then again, we understand that all their objectives should be in alignment with the objectives of the organization, corporate objectives. So they have to be in alignment with the department objective should be aligned with the corporate objectives. Fine. So now in that situation, there is, let's say that there is a particular responsibility center. Let's put this one as A. A produces, for example, a product called as X, and this can be sold in the outside market. It has demand for selling this particular thing. So in the outside market, if they are selling this outside market, let's say that if another internal department B also requires this material, now what is the price which would be charged by the selling department A to the buying department B? At what price would this material be transferred is the transfer price. Now, what is the issue with that? See, when the performance evaluation is the criteria, because now they are divided into departments, now responsibility centers, they want to be evaluated as the best, and the evaluation takes place on whichever department makes the best ROI or earns a maximum return. ROI is high, RI is positive. So those are the parameters which are taken. So they would want to be evaluated the best. So when they are selling this in the outside market, the selling price would include selling price is equal to cost price plus profit. So they are right now selling the products at a profit margin. In case internal department wants the material, so if they charge the same selling price to the internal department, they would be fine. I mean, for them, their profit will be good. But for the buying department, the cost will be high because they also have to pay for the other internal departments profit margin also. So it's not acceptable for buying department. So for selling department, it is good because they would be making the same amount of profit. With the concern that because they are another internal department, if they cut down on their profit margin, their ROI gets affected. So it is not acceptable for this selling department. It would be fine with the buying department if they eliminate this profit margin. They would be paying only for the cost part of it. So now the issue arises, what should be the transfer price? The transfer price is the price at which goods or services are transferred from one division to another within the same organization. Now, this price represents revenue per unit to profit center selling the goods and services, cost per unit to the buying center. This is an internal activity. So this is not externally reported. It's an internal activity. It has to take into consideration what internally takes place, what is feasible for, what is agreeable for both of them. Now, ultimately, both of them belong to the same organization. What if A refuses to transfer this material to the other department B? Then B will have to approach again outside market. maybe we will have to spend a higher price for getting this material from the outside market. Now, for one department it would be fine, the other department it is not fine, because they will have to shell out more to get the material. So the overall impact for the organization, it may not be profitable. So that again has to be taken into consideration. So it is not a mere activity of whether selling department agrees to transfer the material or not to the buying department. So it is not only that particular thing. What is the overall impact which is there on the organization also has to be looked into. Now, in this context, we are going to look at certain situations, what should be considered, what are the practices which are considered in case of transfer pricing. Then we will also look into what are the various methods of transfer pricing. Now, how do you set a transfer pricing? Now, it is not acceptable if profit margin is added, it is not acceptable to B. If it is the profit margin is eliminated, it is not acceptable to the selling department. So now, how to decide? There must be something which they have to agree upon, both of them, and it is feasible for both of them has all to be also to be looked into. Now, setting the transfer prices. Goods and services should be transferred at opportunity cost. Possible situations are: first situation, perfect competition in market for immediate product. So, if there is perfect competition, what does it indicate? There are many sellers, there are many buyers. So, if the selling department is able to sell all their produce, the products which are produced, all of them, if they can sell in the outside market, they should not compromise on the selling reduction in the selling price, but transfer it at whatever is the prevailing market price. See, if it is not transferred to B, A can make maximum profit by selling it in the outside market also. But let's say if there is a constraint, if there is a constraint in the demand which is present, then A has to compromise, or the selling department has to compromise. But let's say if all these units can be sold in the external market, so even when they are transferring the material internally also, they should not cut down on their profit margin. The transfer price would be at the same selling price, that is, which is inclusive of profit margin. Perfect competition, many sellers, many buyers are there. So all of the units which are produced by the selling department will be accepted by the external market. So the same price, why should they forego on their profit margin? That's situation one. Second situation is a situation where, see, not all units all the time operate at optimum capacity. So when we see that on a scale of 0 to 100 capacity level, the maximum capacity level, it may not be a situation that they all the time operate at 100% capacity. Let's say that, for example, if they are operating at maybe 60% capacity, and they have unused spare capacity, surplus capacity of 40%. So that is if it is available with them. At present, they are operating at 60%. If they are operating at 60% and producing the products and selling them, the selling price would take care of all the cost. At 60%, when they decide the selling price is equal to the total cost plus the profit margin. Total cost includes both the variable cost plus the fixed cost. Now, fixed cost, once it is incurred, it's the same from 0 to the maximum capacity level. Now, the selling price has already absorbed the total amount of fixed cost which is incurred. So, total cost includes both variable cost and fixed cost. Now, in such a situation, if they have to use their spare capacity, surplus capacity, produce the product and transfer it to an internal department, in such situation, the transfer price can be as low as the least price what can be charged is the variable cost, because all what they will be incurring for the surplus capacity is only the variable cost, because the total fixed cost which is incurred is already absorbed by the selling price which is decided for those units which are already produced at 60%. So now that they are already operating, the present capacity level at which they are operating, the number of units that are produced and sold, the selling price which is decided on them, it takes care of the total fixed cost which is already incurred. So now no more fixed cost until they reach the maximum capacity. All what they would be incurring if they take up the production beyond this existing capacity, that is for the surplus capacity, it would be only the variable cost, only the marginal cost. So only variable cost is what will be incurred. So variable cost plus a profit margin will be the transfer price. The least price what can be charged is the variable cost. Now transfer, if surplus capacity exists, transfer price would be should recover the marginal cost of supplying division less than price buyer would pay outside company. So technically it would be a negotiation between the seller and the buyer. So for the seller it would cost them only the variable cost. So the buyer, instead of paying the outside market, now he would want to pay anything less than the outside market price. So anything between the variable cost and the market price can be set as the transfer price. So at anything between the variable cost and the market price is the transfer price. That's the second situation. Third situation is when they're already operating at 100% capacity. Let's say that from 0 to 100% capacity, they are already producing at 100% capacity. So there is a production constraint. Now, if such a situation exists, now just to accommodate another department's requirements, they cannot go on increasing the capacity. If they increase the capacity, we understand that anything beyond the maximum capacity will increase the fixed cost in total, full amount of fixed cost. Now, the behavior of fixed cost we see, it is the same until it reaches the maximum capacity. Then it immediately increases once the capacity increases. Then it is stable, constant for reaching till the next maximum capacity level. Then again it rises. Now this is the behavior of fixed cost. This is how we see fixed cost in a very long period of time. In the short period, within that capacity limit, we see that it is constant. But then once the capacity level increases, it very sharply rises, and then it is again stable till the next capacity level. So it goes on. Now, can they afford to increase the fixed cost in this particular level? Is a situation. Then that would increase their overall cost drastically. So what can be done is, maybe now they have to look into the opportunity cost. Maybe they have to think about, consider an option where already whatever are the products which are produced and sold, some of them have to be stopped. If they are stopped, if they are not produced, if they are not supplied to the present customers, whoever are they, then they would forego some amount of revenue. So when whatever is foregone is the opportunity cost. So in such situations, when there are production constraints and a decision is taken to um, withdraw or drop down few units of the product or any product from the product line, if that is dropped, the contribution that is foregone by dropping that product becomes their opportunity cost. At that time, the transfer price is the opportunity cost of lost contribution from other products or extra contribution which would be earned if more or scarce resources were available. So the transfer price would be the variable cost plus the opportunity cost, because they would be foregoing some revenue by not taking up the production and selling them to the others. See, opportunity cost would be the contribution which is foregone, because fixed cost in any situation would be incurred. It is only the contribution which they would be foregoing. So variable cost plus the opportunity cost will be decided as the transfer price in situations where there are production constraints. So the regular practice is how the transfer price is decided. When it is a perfect competition, there's no compromise on the transfer price. It would be transferred at the same price at which they are being offering to the external entity. So competition, in perfect competition, transfer price is equal to selling price offered to the external vendor, external buyers, outside market, external buyers. Second situation, when there is a surplus capacity available, there is unutilized capacity, a set transfer price can be anything between the variable cost and the outside selling price. If there are production constraints wherein they are already operating at maximum capacity, and the decision is if it is to cut down on the existing production or cut down on the supply of units to external entities, then the contribution that is foregone has to be recovered from the price which is charged to the internal department. So what would be the transfer price will be variable cost plus the opportunity cost. Now the same thing is explained here again in the methods of transfer pricing. It says practical methods of transfer pricing. First one is cost plus. Cost plus, producer calculates unit cost plus a profit margin. Many add margin to guarantee profit. Use standard cost to avoid passing on inefficiencies and ensure variances reported. That's, they have a tight control over their cost. Ensure that there is no excess cost incurred. All their costs are appropriately spent and incurred. So the price is cost plus profit margin. So that's the first practical methods of transfer pricing. What are the issues with this? Supplying division wants to use total absorption cost to ensure recover fixed costs. Supplier's fixed cost becomes variable cost for buying division. This can lead to wrong economic decisions. The supplying division and the buying division. Now, the supplying division's transfer price will be set as total cost plus the profit margin. But the buying division, for them, if the total cost is included and the profit margin is included, it is unbearable for them because their cost per unit increases. That will result in their inefficiency. So the buying department would want only the variable cost to be charged. Variable cost, maybe some amount of profit margin is added, is what is acceptable for the buying division. So that is again one issue. See, fixed cost is inevitable. Fixed cost in any case has to be incurred. So the buying division may have the opinion that because it is an unavoidable cost for you, why should that be charged here? But how would they recover their fixed cost? So there is always an issue with this transfer price between the selling division and the buying division. So when it is no particular price is acceptable for both of them, then they would go in for negotiation and then they discuss and agree upon some price. There are two-part pricing, that is in the external market, they may charge total cost plus price, the profit margin. Internally, when they are supplying, they can consider supplying it at variable cost plus profit. So that is two-part pricing. From the external buyers, they will recover the fixed cost. The price which is charged to them will take care of the fixed cost which have to be recovered. But the price which is charged to the internal department, they may give a price or charge a price which is equal to variable cost plus the profit margin. That is two-part pricing. Another thing is market price based. Perfect competition, when it exists, then the price would be division's product must be same as offered by the market. Adjust market price for cost not incurred on internal transfer. So these are the practical methods of transfer pricing. We will take up, I will just